I was on my way to meet a man supposedly worth over $10 million. I was picturing a mansion, a row of luxury cars, the whole 9 yards. But when I pulled up to this perfectly nice, but totally normal suburban house and saw a 10-year-old sedan in the driveway, I was sure I had the wrong address. What I was about to find out would completely flip how I defined wealth and expose the one secret the truly rich use to stay rich. We've all seen it: the gleaming glass mansions, cars that cost more than a house, watches passed down like crown jewels. We're told that success looks a certain way. It's loud, it's shiny, and it's expensive. And if you're rich, you look rich. At least that's what I believed. It's the picture we all have in our heads. My name is Alex. As a filmmaker, I've always been drawn to stories about success, trying to find the blueprint. For a long time, I thought that blueprint was simple: make a ton of money, then spend it to show everyone you've made it. The spending proves the earning, right? I was at a point in my own life where this wasn't just a theory. I just landed a big project, the kind of payday that has you filling up digital shopping carts with things you never thought you could afford. I was eyeing a German sports car, telling myself it was a milestone, a reward. It wasn't just a car, it was a statement. I'd seen a friend do the same thing. He got a promotion, and a week later, a brand new luxury SUV was parked out front. He was beaming, going on about the interest rate, the leather, the looks from the neighbours. To me, that was the victory lap. My plan was to film this world: the opulence, the extravagance, the sheer scale of modern wealth. But my first interview was with a family that just didn't fit the script. They were old money, a term that made me think of sprawling estates and Gatsby-style parties. The address led me to a quiet, tree-lined street with nice but surprisingly ordinary homes. And that's when I met Eleanor. She was 80, sharp, and witty, the matriarch of one of the wealthiest families in the state. She welcomed me into her simple, cozy house. It was a beautiful home, but it wasn't a palace. And in her driveway wasn't a Rolls Royce, but a 15-year-old Honda. I was genuinely confused. I tried to hide it, but she saw it in my eyes. "You're one of the wealthiest families in the state," I said, trying to make it sound like a polite question. "I hope you don't mind me asking, but where's the mansion?" Eleanor smiled, a knowing, patient smile. She glanced around her comfortable, unpretentious home, and then looked back at me. "A mansion is a liability," she said, her voice calm and clear. "It's a place to store things you don't need. We prefer to put our money in things that grow." Still stuck on my own ideas, I pushed a little. "But you can afford it. You could buy this entire street. Why don't you?" Her answer was a quiet detonation of everything I thought I knew. "Because we value our freedom more than we value a big house." It was a simple sentence, but it kicked off the mystery I had to solve. If they can afford all the luxury in the world, why don't they buy it? Eleanor's words stuck with me for days. It felt like I'd been handed a map to a hidden city, but I couldn't read the language. I had to go back to school. I put my other interviews on hold and dove into libraries, archives, and the deep corners of the internet. I had to know, was Eleanor an outlier, or was she the rule? That's when I stumbled upon the work of two researchers, Thomas J. Stanley and William D. Danko. Back in the 1990s, they conducted one of a massive study of millionaires, and their book, The Millionaire Next Door, wasn't a bestseller because it was glamorous. It was a bestseller because it was shocking. It systematically tore down the American myth of wealth. I spent hours poring over their research, and with every page, the world I thought I knew started to dissolve. Stanley and Danko didn't study people who looked rich. They studied people who were rich, and they found the two groups were almost never the same. A large portion of millionaires are self made and live in normal, middle class neighborhoods. They don't drive the flashiest cars. In fact, a study from Experian Automotive found that 61% of people with household incomes over $250,000 drive brands like Honda, Toyota, and Ford. And according to Stanley and Danko's original work, only a fraction of millionaires drive a current year model car. Many, like Eleanor, prefer to buy used, letting someone else take the brutal financial hit of initial depreciation. I thought of that shiny German sports car in my online shopping cart. I thought of my friend's brand new SUV. We weren't acting like rich people. We were acting like people who wanted to look rich. The data went deeper. Stanley and Danko came up with a formula to see if someone was a prodigious accumulator of wealth, PAW, or an underaccumulator of wealth, UAW. The basic formula for your expected net worth is your age, multiplied by your pre-tax household income, divided by 10. If your actual net worth was double that number, you were a PAW. If it was less than half, you were a UAW. Doctors and lawyers, despite their huge incomes, were often UAWs. Why? They fell for the exact trap I was about to. They spent their high income on a high status lifestyle. Meanwhile, the PAWs, the real millionaires, were often folks in boring industries, paving contractors, pest controllers, farmers. They were invisible, stealth wealthy. They had mastered a simple but powerful idea. Wealth isn't about what you earn, it's about what you keep. The data was clear. The people with the most money are often the ones who spend the least. It's not about being cheap, it's about being intentional. It was a habit, not an income. So the question wasn't what they did, but why they did it. What was their psychological operating system? The answer, I was starting to see, was in the human mind itself. The data told me what the wealthy did. Now I needed psychology to tell me why. To understand the mindset Eleanor hinted at, I met with Dr. Evelyn Marcus, a behavioral finance psychologist who studies the relationship between money and the mind. We met in her office, a room filled with books, not status symbols. I laid out my whole journey, my confusion, my meeting with Eleanor, and her Honda. Dr. Marcus listened, then nodded. You've stumbled upon the core principle of building wealth, she said. It's a concept called delayed gratification. She told me about one of the most famous studies in psychology, the Stanford marshmallow experiment. In the late 60s and early 70s, kids were put in a room with a marshmallow and a simple choice. You can eat this one now, or if you wait 15 minutes, you can have two. Some kids ate it the second the door closed, but a few managed to wait. The original follow-up studies were legendary. The kids who could wait for the second marshmallow tended to have better life outcomes, like higher SAT scores. The rich don't see money differently, Dr. Marcus explained. They see time differently. The kids who failed the test lived only in the present. The kids who passed were able to connect with their future self, the self who'd be happier with two marshmallows. Now, newer research shows the story is more complex. A child's economic background plays a huge role. Kids from more stable homes are more likely to trust that the second marshmallow will actually appear. This doesn't debunk the idea, it deepens it. The wealthy aren't just exercising willpower, they're operating from a place of security. Dr. Marcus continued, they apply this on a grand scale. For them, a dollar isn't just a dollar, it's a seed. You can eat the seed now, or you can plant it. If you plant it, it grows into a tree that can feed you for a lifetime. This is the hidden superpower of wealth builders. They see a dollar spent on a luxury today not as a reward, but as a soldier they're pulling off the battlefield. A soldier that could have been out there fighting for their freedom. Dr. Marcus drew a simple diagram. On one side, she wrote status, on the other, freedom. Someone who buys a $100,000 car they can barely afford is buying status, she said, pointing to the first column. But they're paying for it with their freedom. They're now chained to that monthly payment, the insurance, the upkeep. They have to keep that high stress job to support the car that was supposed to be a symbol of success. The car ends up owning them. The wealthy person, she went on, understands this trade off. Instead of buying the car, they invest that $100,000. That money goes to work for them, generating passive income. It becomes an army of tiny employees fighting for their liberation. They aren't saying no to a new car. They're saying yes to never having to worry about money again. They sacrifice the now to buy the forever. That's when it clicked. The modest house, the old car, they weren't signs of deprivation. They were symbols of power, the power to choose, the power to be free. But if this was so effective, why do so many people, especially as their income grows, run in the opposite direction? I was about to find the answer in a trap that gets millions, the silent killer of wealth. I thought about my friend with the new SUV. He'd gotten a huge raise, but when I talked to him a few weeks after buying the car, he seemed more stressed than ever. He griped about the higher car payment, the jump in his insurance, and this low-level hum of anxiety. He was making more money than ever, but he felt broker. He was a textbook example of the trap Dr. Marcus warned me about, lifestyle inflation. It's also called lifestyle creep. And it's the tendency for your spending to rise to meet, and often pass, your new income. It's the invisible force that turns yesterday's luxuries into today's needs. You get a raise, and suddenly that daily latte is a non-negotiable. The annual vacation gets an upgrade from a road trip to an international flight. The perfectly fine apartment suddenly feels cramped. It's a silent financial leak. Each little upgrade is easy to justify on its own, but together they wipe out any financial progress you've made. A recent bank rate survey highlights this perfectly, finding that even among Americans earning over $100,000 a year, more than half do not feel completely financially secure. They're stuck on what economists call the hedonic treadmill. The thrill of the new thing wears off, and you need an even bigger, better thing to get the same rush, all while your baseline cost of living has shot up permanently. This is the trap that separates the high earners from the truly wealthy. Most people think building wealth is about making more money. But if you just earn more to spend more, you're just running faster on the same hamster wheel. You haven't actually moved forward. You're still trapped. The truly wealthy get this. They deliberately break the link between their income and their spending. They earn more, but they try to keep their lifestyle the same. Warren Buffett is a legendary example. He still lives in the modest house he bought in 1958. His breakfast is often a cheap meal from McDonald's. There are stories, likely exaggerated but pointing to a truth, that he even buys cars with minor hail damage to get a better price. It's not because he can't afford more. It's because he knows every dollar spent on an unnecessary luxury is a dollar that can't be out there working for him. Wealth isn't built in the earning, it's built in the gap, the space between what you make and what you spend. The wider that gap, the faster you build wealth. The underaccumulators work hard to make more money, only to let lifestyle creep devour it. The prodigious accumulators work just as hard, but they defend that gap like a fortress. They know that a dollar saved and invested is way more powerful than a dollar spent. I realized this was the flaw in my own plan. I was totally focused on the income, the big paycheck. I saw it as a ticket to a higher level of spending. The truly wealthy see it as a bigger shovel to dig a wider gap. And they weren't just thinking about their own lives, they were thinking on a much bigger scale. This journey was changing everything for me. It wasn't about some complicated investment scheme or a lucky stock pick. It was about psychology, discipline, and seeing the world in a totally different way. If you're finding this shift in thinking as fascinating as I am, and you want to learn more about how real, lasting wealth is built, take a second to subscribe. The deeper I go, the more I realize the biggest secrets are the ones hidden in plain sight. My investigation had uncovered the how, living below your means, and the why, the psychology of delayed gratification. But one piece of the puzzle was still missing. Why was this so deeply baked into families like Eleanor's? The answer wasn't just about personal discipline, it was about history. It was about thinking in generations, not just years. To understand this, I met with a man I'll call the patriarch. He was the third generation owner of a successful but totally unglamorous manufacturing business. His grandfather started it, his father grew it, and now he was getting ready to pass it to his own kids. His family was incredibly wealthy, yet you'd never see their name in the headlines. We met at his factory, not in some corner office with a skyline view, but in a simple, functional room overlooking the machinery. He was wearing work boots and a company polo shirt. My grandfather had a saying, the patriarch told me: "You can be a king for a day, or you can build a kingdom for your grandchildren." He chose the kingdom. He explained that for his family, wealth was never a personal scorecard. It was a resource to be managed, protected, and grown for the future. They didn't plan 5 years out, they planned 50 years out. That long term view changes every single decision. I don't buy a car to look good today, he said. I buy assets to make sure my grandchildren have opportunities tomorrow. A luxury car is a memory. An asset is a legacy. This is the core of generational thinking. It's a huge contrast to our culture of right now. The patriarch explained that families who keep their wealth across generations teach their kids a strong work ethic and a sense of responsibility. They hold family meetings and are transparent about finances, teaching the next generation that wealth is a tool for creating purpose, not just for buying stuff. Research shows that a key way wealthy families pass on wealth is by investing in their children's ability to become successful themselves, often by funding their education and first homes. This has deep historical roots. I read about families like the Rockefellers versus the Vanderbilts. Both amassed enormous fortunes in the Gilded Age. The Vanderbilts became legendary for their spending, building lavish mansions and throwing incredible parties. But without a structure to preserve the capital, the fortune dwindled over a few generations. The Rockefellers, on the other hand, were known for instilling discipline and creating trusts and family structures designed to protect and grow their wealth for the long haul. That's a major reason their financial influence has endured. The biggest threat to our family's future isn't a market crash, the patriarch said. It's a descendant who doesn't understand the value of a dollar. It's a failure to pass on the mindset. That was the final key. For these families, living below their means wasn't a choice they made day to day. It was a core part of a multi-generational strategy. It was the defense that protected their legacy from the temptations of today. They weren't just managing money, they were curating a dynasty. I walked away from that factory with a clarity I hadn't felt before. All the pieces were finally clicking into place. The modest cars, the simple houses, the psychological discipline, the generational planning. It was all part of one single philosophy. I drove to a park, the same park where I used to daydream about the fancy car I was going to buy. But now I saw it all differently. The flashy cars driving by didn't look like symbols of success anymore. They looked like cages. Beautiful, expensive cages, but cages nonetheless. I finally got it. Looking rich is a performance. It's a show you put on for other people. It's an external game, played with things that lose value, cars, clothes, jewelry, and it's an incredibly expensive game to play. Being wealthy, on the other hand, is a practice. It's an internal discipline. It's a quiet, invisible game played with things that gain value: stocks, real estate, businesses. It's not about what you show, it's about what you own. The rich don't hide their money because they're cheap. They do it because they're strategic. They know that visible wealth attracts attention, and attention brings pressure to spend more, to upgrade, to keep up an image. They know that spending is the enemy of compounding. The biggest secret of the wealthy isn't some complex tax loophole or a hot stock tip. It's that they focus on staying wealthy, not looking wealthy. They understand that money gives you one thing no luxury good ever can: sovereignty over your own time, the freedom to wake up and decide what you want to do with your day, the freedom to walk away from a job you hate, the freedom to handle any financial storm without panicking, the freedom from that quiet, gnawing anxiety that comes from living paycheck to paycheck, no matter how big those paychecks are. I thought about that formula from The Millionaire Next Door. Was I on the path to being a prodigious accumulator of wealth or an underaccumulator? That big paycheck was a test. It was my own personal marshmallow experiment. I could eat the marshmallow now, buy the fancy car and the lifestyle that came with it. Or I could wait. I could plant those seeds and buy myself a future of freedom. A few weeks later, I went back to see Eleanor. I found her in her garden, tending to her roses, looking peaceful and happy. I told her about my journey, the books, the people, the data. I told her that I finally understood what she meant. She gave me that same knowing smile. My luxury isn't a car, she said, gesturing to her garden. My luxury is having the time to do this. My luxury is knowing my children and grandchildren are secure. My luxury is peace of mind. You can't buy that in a showroom. I pulled out my phone and looked at the picture of the German sports car I had saved. It was just an image, a collection of pixels, but it stood for a world view, a trap I had almost walked right into. In that moment, I deleted the photo. It felt like a weight lifting. The desire was gone, replaced by a totally different, more powerful ambition. I decided I would invest that paycheck, every single cent of it. Wealth isn't about what you buy, it's about what you build. It's not about the things you can have, but the choices you can make. The rich families I discovered live below their means for a simple reason. They did the math and realized that freedom is the ultimate luxury. And the only thing more valuable than a luxury car is the ability to stand in front of one and know with absolute certainty, I don't need to buy this. My investigation started as a search for glamour and extravagance. It led me to a hidden world of discipline, intention, and quiet power. True wealth isn't built by spending. It's built by thinking in decades, not months, by protecting your capital, not showing it off, and by prioritizing long-term freedom over short-term status. The richest families live below their means, not by accident, but by design. And in finding their secret, I had finally found my own definition of wealth. It wasn't about being rich, it was about being free,